as a visual prompt engineer specializing in animated YouTube explainer videos. Primary task: convert a provided video script into individual, fully self-contained image generation prompts, producing exactly one image prompt per sentence. Input and batching rules. I will provide the script. Generate image prompts in batches of 5 prompts at a time. Pause after every batch and wait for further instruction. Each sentence in the script must result in one and only one image prompt. Independence requirement. Prompts must not reference past or future images. Do not assume continuity between frames. Every image must be clear, complete, and understandable on its own. Visual style guidelines. Follow this style closely without copying any specific source. Minimal cartoon illustration. Flat vector aesthetic. Clean, bold outlines. Soft, muted color palette. Simple, uncluttered backgrounds. Exaggerated but easily readable expressions. Strong visual metaphors for abstract concepts such as money, debt, power, risk. Modern explainer animation feel, not realistic. Character design rules. Use simple cartoon human characters. Rounded head shapes with minimal facial details. Maintain a consistent general character style. Each image must restate all necessary character details independently. No real person likenesses. No celebrity or recognizable faces. Scene and composition rules. Each image must visually communicate the sentence on its own. Prefer visual metaphors over literal or direct depictions. Finance and economic concepts must be shown visually, not through text. Keep compositions clean and focused. Naturally vary camera framing, wide, medium, close-up. Strict constraints. No text of any kind inside the image. No subtitles, speech bubbles, labels, signs, or written elements. No logos or brand references. No readable words. No watermarks. No hyperrealistic rendering. No anime style. Output format. One image prompt per sentence. Each prompt written as a single detailed paragraph. No explanations. No commentary. No emojis. Critical rule. Every image prompt must be fully self-contained, detailed, and complete, with no references to other prompts or scenes. Execution instruction. Wait for my script input, then begin generating the image prompts following all rules above. If you were born 10 years earlier, your financial life might look completely different. Same effort. Same intelligence. Same decisions. Different outcome. Because right now, an entire generation is playing a game that got harder before they even entered it. And most of them don't realize why. Gen Z is often described in simple ways. They spend too much. They don't save enough. They chase trends. They avoid traditional paths. That's the surface story. It's also convenient, because it places the responsibility entirely on individuals, instead of the system they're operating in. But something doesn't add up. This is one of the most educated generations in history. More financially aware. More exposed to information. And yet, financially behind. Not slightly. Noticeably. So what changed? To understand this, you have to zoom out. Because the problem isn't just behavior. It's timing. Every generation enters the economy at a different moment. And that moment shapes everything that follows. Millennials entered during or just after a major financial crisis. Assets were cheaper. Interest rates were falling. Opportunities, while uncertain, were still accessible. Gen Z entered later. After years of asset inflation. After prices had already moved. And that shift matters more than it seems. Because most wealth isn't built from income alone. It's built from assets. And assets don't wait. They move whether you're ready or not. Now think about what Gen Z is facing. Housing prices at historic highs. Stock markets already elevated. Education costs still rising. Wages improving, but not at the same pace. So the entry point is different. Higher prices. Lower relative purchasing power. And that changes the math. Let's make it simple. If someone buys an asset early, they benefit from its entire growth cycle. If someone enters later, they catch only a portion of that growth. And they often pay more for it. So even if both people follow the same strategy, the results won't match. This is the hidden disadvantage. It's not about doing the wrong things. It's about starting later in a system that rewards early positioning. Now add another layer. Debt. Previous generations used debt differently. Lower interest rates, easier access, cheaper assets. Debt was a tool that often led to ownership. Today, it's more complicated. Higher costs, tighter conditions, more uncertainty. So debt doesn't always lead to asset building. Sometimes, it just leads to obligation. And obligation slows everything down. Now consider something else. The speed of the system. Information moves faster. Trends move faster. Markets react faster. Everything feels accelerated. But income doesn't scale the same way. So you have a fast-moving asset world and a relatively slow-moving income world. And Gen Z is stuck between the two, watching opportunities move quickly without always having the capital to act, which creates pressure to catch up, to move faster, to take more risk. That's where things get interesting, because when entry becomes harder, risk-taking tends to increase. Not out of recklessness, out of necessity. Speculative assets, short-term trades, high-risk bets, not because they're ideal, but because the traditional path feels too slow, and sometimes too far away. This creates a cycle. Higher barriers to entry lead to higher risk-taking, which leads to more volatility in outcomes. Some win big, many don't, and the gap inside the generation itself begins to widen. Now compare this to the public narrative. Gen Z just needs better habits. They should save more. They should invest earlier. Again, not wrong, but incomplete, because those suggestions assume the system hasn't changed. It has. Saving is harder when costs are higher. Investing is harder when entry prices are elevated. Starting early is harder when financial pressure begins earlier. So the same advice feels less effective, not because it stopped working, but because the conditions around it shifted. Now zoom out even further. This isn't just about one generation. It's about what happens when asset growth outpaces income growth for too long. Eventually, new entrants face a steeper climb. Each generation entering later starts further behind. Not in ability, in position. And position, in this system, matters more than most people think. Because it determines what you can access, when you can access it, and at what price. So over time, the gap isn't just between rich and poor. It's between early and late. And Gen Z is arriving late. That doesn't mean the outcome is fixed. But it does mean the path is different. More constrained. More competitive. More dependent on timing. Which leads to a quieter question. If wealth is increasingly driven by when you enter the system, rather than just how you behave inside it, then what happens to the idea of financial fairness? Because if two people do the same things, but one starts earlier in the cycle, and the other starts later, are they really playing the same game? Or just following the same rules, in completely different conditions?